Hi there, Andy Ellison here with eXp Realty. So with the shifting real estate market and the widespread inflation, we are now seeing short sales come into play. In this video, I'm going to be outlining not only what a short sale is and how it's different than a foreclosure, but I'll also highlight some potential benefits that the short sale process can offer to both sellers and buyers. First up, let's talk timeline. So when does a home go into short sale? To put it simply, a home goes into short sale when the homeowner realizes they can no longer afford to keep up with their mortgage payments. Instead of waiting for the bank to foreclose on the home, the homeowner initiates the short sales process by submitting an application to the mortgage lender. There are two critical factors that the lender will consider when deciding whether to approve a short sale. Number one, the home has to be worth less than what the homeowner owes on it. The lender will want to review recent sales of comparable properties to make sure this is the case. Number two, the seller must be able to provide financial hardship. They have to show that they don't have the income or the assets to pay for the rest of the outstanding balance. So now what exactly is the difference between a short sale and a foreclosure? So in a nutshell, short sales and foreclosures both occur when homeowners are struggling to keep up on their mortgage payments, or if they find their mortgages underwater. An underwater mortgage is when a borrower owes more money than the home is worth. In both cases, the homeowner can lose the possession of their property, though the circumstances and repercussions are different. The extent of the seller's control is a significant difference between these two processes. In a short sale, a seller will decide to submit a financial package, seeking a lender's approval to sell the property for less than the amount they owe on it. Therefore, the seller enters into this process voluntarily, which is not the case for a foreclosure. Once a lender approves a short sale, a seller is in charge of selling the property. However, the lender is responsible for negotiations and determines whether to accept or reject buyers' offers, as it is the lender who is trying to recoup costs. On the other hand, a foreclosure is a legal action taken by a lender to seize a seller's property after they fall too far behind on their monthly payments. Although both processes can have negative impact on a seller's credit, a foreclosure can have a far more damaging impact on a seller's FICO score and how long they have to wait to get a mortgage again. Furthermore, the foreclosure process can be expensive for the seller and lender, and ultimately, in some cases, force them to file for bankruptcy, which that's something nobody wants. Now let's talk benefits. While they vary, thoughts of a short sale probably brings up negative connotations. There are potential benefits for all parties involved. Maybe more than benefits, we should refer to them as silver linings. Let's take a closer look at the benefits for both buyers and sellers. For buyers, short sales can provide great investment opportunities. Straight out, you will probably be able to get a property for a discounted price. That said, the short sale property will, of course, be priced according to the market value, and the lender will definitely be highly motivated to sell in order to cut the bank's losses. As a result, buyers can often get better deals on homes than they would have if they purchased through a typical sales process. In addition, buyers of short sales typically are working in less competitive markets. Given the lender's entanglement in the deal, short sales are far more complicated than traditional sales. Since most buyers are not experienced in short sales, they tend to shy away from them. There's less competition and a better chance to receive an offer and get it accepted when there are fewer interested buyers. Now, let's turn and look at possible benefits sellers could see from going with a short sale. Number one, and of most importance, a short sale could very well prevent one from heading into a foreclosure situation. And of course, a foreclosure will be far more detrimental to the credit score. 2, debt absorption. The majority of sellers' debt will be paid off by the home buyer. 3, savings on fees. In a typical sale, a seller will have to pay for agents' commissions, but in a short sale, the lender pays for those fees. Number 4, potential debt forgiveness. It's possible that the lender will accept the proceeds of the short sale and write off the remaining debt as a loss. In these cases, the seller is not held accountable for paying off whatever debt remains after the short sale. Number 5, housing market reentry. Going with a short sale enables the seller to re-enter the market and obtain a mortgage immediately with a Federal Housing Administration FHA loan, under, of course, the right circumstances. In order to do this, you have to have no late mortgage or installment payments in the last year prior to the short sale and no late mortgage or installment payments in the year prior to applying for the new mortgage. Now, let's talk about the drawbacks because of course short sales do have some potential drawbacks for both buyers and sellers. First, let's talk about what it could be like for potential buyers. Number one, it will be time consuming. A short sale usually takes a much longer period of time than a traditional sale because of the lender's involvement. In an attempt to recoup as much money as possible, the primary lender and any junior lien holders involved will take their time negotiating and closing the deal. Remember, the more lien holders there are, the longer the process will take. Furthermore, there are times when the seller delays the sale because they either second guess their decision or are unprepared with the necessary paperwork. Number two, there is an increased risk involved. Since short sales are sold as is without typical disclosures like a seller's disclosure, the condition of the home and the quality of the deal are not always clear to the buyer. Moreover, there is no guarantee that the deal will actually close. So the buyer may risk spending time and money on a home they're unable to purchase in the end. Number three, be ready to do more homework. A short sale requires the buyer to put in a lot more work up front. Doing research to figure out the true value of the home, discovering all the liens on the property, and identifying any issues with the property's condition are essential to determining whether the purchase is worthwhile. And then last, of course, there could be concerns with the property's condition. Given the fact that short sale sellers are financially strapped, their properties tend to be in worse condition than average homes sold on the market. Therefore, the buyer often has to spend a lot more money on repairs and improvements right away. So what about drawbacks for sellers? Although there's many benefits for the sellers during a short sale in real estate, which we touched upon earlier, they also come with drawbacks such as 1. No negotiation power. Although a seller plays an active role in the sale of the property, the lender is the only one with the power to negotiate purchase price of the home. Number 2, lack of profits. Since a seller owes money to the lender, they won't receive any of the proceeds from the sale of their home. 3, credit score damage. A short sale can do real damage to sellers' credit scores. The higher your credit score, the larger the hit. However, short sales tend to cause sellers' credit scores to drop by fewer points than foreclosures. Number 4, delay in obtaining another mortgage. After a short sale, a seller must complete a waiting period before qualifying for a new mortgage. Outside of an FHA loan, the waiting period may be anywhere from 2 to 7 years. There's a lot of ins and outs to know about when it comes to short sales. If you have any questions about what I just covered or would like to discuss any of this in more detail, please don't hesitate to reach out. You can call me or text me directly at 208-598-3040 or shoot me an email. And to help us stay in touch, please be sure to take a quick second and subscribe. Have a great day.